The property has to perform. We have to sell the we have to be able to sell the property for more than what we paid for it in order for us to get paid. Okay, update on the Phoenix property, Phoenix, Arizona. We've got a 23-unit building. It has been completely renovated. The base of the renovation was repurposing the building from executive office space to really it's pretty much Class A. The only thing that Class A apartments, the only thing separating it from Class A would be the lack of amenities in terms of, like, for example, a pool, almost like a dog park kind of thing, and I don't even know what else. I'm trying to think. I'm trying to
don't rack your brain too hard.
Yeah, I'm trying to. It doesn't matter, anyways. But really good property. Heavy parking. I think it averages about 3 spots per unit, which is heavy. The majority of the units are 2-bed, so having 3 spots per unit is a big advantage. So that you can also have guests on site in your lot. About half of the parking, I believe, is covered. Right now, we're looking at a $5.4 million purchase price. The LTV looks like it's coming in at about 65-35 is kind of where the market is. I'm trying to push for somewhere. I'm trying to push for higher leverage, closer to 70, because the LTV, or sorry, the debt service, the debt coverage service ratio.
Yeah.
Right.
Yeah.
I'm always like, wait a minute. So the ratio, the coverage, I usually call it coverage ratio anyways. Yeah. So DSCR. Yeah. There we go. The coverage ratio is, if the lender's underwriting can get a little bit aggressive. I had a discussion with them. This is why it's good to develop a relationship with these guys and kind of really try to, I guess, build rapport with them, right? Because what they're doing is they're presenting a little bit of a narrative for us to they're brokers, so they're presenting a little bit of a narrative to these lenders and especially the agencies right now, because I want to go higher leverage. Anything that dips below 70, I hate. I shouldn't say I hate. I don't love, right? But it's the nature of the market right now where 65-35 is kind of almost arguably the max for good quality property. Now, the reason why it's the max for good quality property is because good quality property doesn't come with, an 8 cap. Right? It's usually obviously lower. So when your cap rate is typically lower, the lending on the deal is either going to be restricted by the coverage ratio or it's going to be restricted by the LTV. So one of the two. So that tends to be the issue here, but we're still looking at almost 7.5 cash on cash, and we're looking at a base case of around 210% total ROI and an annualized ROI base case of about 42%. Now, the reason why I'm mentioning base case is because we have in our analysis here, in our deal sheet, we have moderate downside total ROI, and then we also have moderate upside total ROI. So we use an in-between analysis of a base case scenario. So same thing with annualized ROI as well as even average ROI. So we have everything from moderate downside to moderate upside. So we use a base case right in the middle to not get too crazy and stay conservative with the deals. So we're still looking at, and that's with investments of a good size investment of about a couple $100,000, where the equity split at the end, which is purely performance based, where we only get paid if the property performs well and there is a capital gain at the sale of the property, which means we bought the property for X and it sold for more than X. That's the only way we get paid. If the property does not perform well during the entire hold period, Coachwood Capital and even me, I've done all that work for say 5 or however long the term is. I've done the work for nothing, and we don't get paid a dime, a penny. So the property has to perform. We have to sell we have to be able to sell the property for more than what we paid for it in order for us to get paid. So the numbers that I just spit out, that's if you're investing a good chunk, and which the majority of our investors, they're serious investors, so they do, they invest a good amount of money. So that's what the deal's looking like. Phoenix, Arizona. A couple other interesting.
Connor, let's have that hit even like the Coachwood Capital page too.
Yeah. Couple other things that are pretty interesting to note about that property is a major developer purchased. It's almost kind of like an RV park behind this particular property. Purchased that property and is going to be developing. They believe they're going to get me more information because they actually work with this buyer. They're going to be developing high-rise luxury condos next door.
Nice.
There's already, I don't want to say luxury, but Class A condos also right next door that have already been developed. These, I would say, even though they're being marketed as Class A, because of the lack of amenities, I'd say that they're Class B, but with arguably, newer finishes and Class A feel, I want to say.
Where in Phoenix is this?
This is in.
I was looking into Phoenix kind of over the weekend.
I'll get a little bit more info for you.
And that, I think it's northeastern Phoenix as you head towards Scottsdale is like booming.
Yeah.
Yeah.
So the submarket that it's in is Midtown Phoenix. The submarket cluster is downtown Phoenix. Let's take a look at the map. Fuck, I borderline don't even know how to make sense. Yeah, it's what did you say? North what? East?
Northeast, I think.
Yeah.
It is.
So.
Oh yeah, nice.
Yeah, so it's like northeast of Phoenix.
Yeah.
So I'll clip this out and show Connor. Yeah, so it's in between. It's almost in between Scottsdale and Phoenix, right? Let's take a quick look at the submarket details. We've got.
Because Scottsdale is kind of like a North Miami to Miami. It's like that it's a lot of new development, new money's going in there.
So Scottsdale is what North Miami is for what Phoenix is to Scottsdale. Does that make sense?
No, we're like where Miami is at its core is like an older city, or maybe like a Brickell, I guess you could say.
Okay.
Right, where it's like,
and that's Phoenix.
Is Scottsdale. Scottsdale is like the newer up and coming, lots of like people moving there, very fast, rapid like population growth rate, like new businesses going in there. Yeah.
Okay.
It's like even Scottsdale in the greater Scottsdale area.
Okay, so what I'm saying is Phoenix is bigger than Scottsdale. Phoenix is
that's
the driver.
The core city.
Exactly. Phoenix is the driver, so it'd be like Phoenix is the Miami.
Is the Miami, yeah.
And Scottsdale is like the North Miami when you're comparing North Miami to Miami. Scottsdale is the North Miami of Phoenix.
Yeah.
Yeah. Okay. Got it. Yeah. So we're seeing also, population growth for the next 5 years of 10%.
Yeah.
Which is crazy.
Yeah.
Great. It's a 12-minute drive from the Phoenix International Airport.
Wow.
12 minutes. Yeah.
Wow.
Yeah, so they're rating it as a Class A four-star low-rise apartment, which is, it was built to. It was built the way that this. Oh fuck! It's showing under contract already. That's me. Average household income within a 2-mile radius is 78,952. Within a 5-mile radius is 81,000 and change.
Yeah.
And with a 10-mile radius, it's 78,000. So what does this mean? It's fucking high. comparatively speaking. Within a 2-mile radius, the average median home value is 310, not average, or the median home value, not average home value. So the median is 310. So if you were to bring that into an average number, it'd be much higher than 310. Within a 5-mile, you're 39,000, and within a 10-mile, it actually drops to 72,000. And how to interpret that? That's actually pretty high, relatively speaking. Very strong drivers in the market here. Like within a 2-mile radius, the historical annual growth rate from 2010 to 2022 was 2.6%, and annual growth from now until the next 5 years until 2027 is about 2%. Now, the reason why this is very interesting is because there's a lot of doom and gloom, right? Very, very much doom and gloom going on right now, and for a submarket like this to still show annualized growth for an average of 2% moving forward is huge. There's a lot of things going on in that submarket. Population, you're well over 1 million. You're almost 1.5 million people within a 10-mile radius. That's huge. Within a 10-mile radius, that's how close it is to Phoenix. It's obviously in Phoenix, but that's how close it is to the core of Phoenix, which is huge. What I like to do is I love to base my buying also based off of, especially if I'm buying market apartments, market rate apartments. I want to make sure that the population can support, very low vacancies. Yeah. And when you have, for example, the population right here is 2022. Population is 1.486 million people within a 10-mile radius. That can support very low vacancies. All of the bedroom sizes, all of the market asking rents per square footage are all on the upswing. They were actually higher at one point in Q2 of 2022, which makes sense. That was the height of the market. We were looking at March, April, right? So it came down from there. And the next time we're going to anticipate levels to be above what they were is 2026 Q1. But what's happening is we're seeing high demand in rent, which probably hasn't been built into these models yet based on affordability of rates. And I had another interesting conversation with the lenders today. Get rid of this shit. I had another interesting conversation with lenders today mentioning that agency loans have gone down in price. So the market's getting very competitive moving forward. So, we're seeing pretty good things right now. It's actually not happening the way that people thought this would all go down, at least up until this point. Will it? I don't know. I don't have a crystal ball, but it seems like it's not happening. It's not happening the way that people thought it would be happening, which is great news. I hope it kind of settles right around at a 5% mark. That's where I'm kind of hoping rates settle. Maybe even a little bit lower, maybe 4.5. That's where I kind of hope it settles.